It's not the market's fault. It's your mindset. Here's why you keep missing out. Why are so many investors just spectators? Do you ever feel like you can only watch the market from a distance? The market is rising. Everyone is posting profits. You scroll and say, wow, if I had entered yesterday, I would have already made a profit. But in reality, you stay on the sidelines, doubtful, confused, waiting for the right moment. This isn't just the case for one or two people. Around the world, many investors, even experienced ones, are often caught in this position, watching the market fly, but not going up. Or worse, they just get the courage to enter when it's too late and end up getting stuck. Why does this keep happening? Is it because we don't understand the market? Not really. Most people now have access to data, charts, analysis, but many are just spectators, not because of lack of knowledge, but because they are defeated by a bigger enemy, themselves. In this episode, we'll explore why many investors are stuck on the sidelines. We'll discuss the psychological traps, common strategy mistakes, and most importantly, how to avoid being a spectator. Ready? Let's start with the most common but hardest to avoid, the obsession with timing the market. Chapter 1, Timing the Market Obsession, an Expensive Dream. Okay, let's start with the classic dream of every investor. Get in at the bottom and sell at the top. Yes, that dream, buy when everyone is scared, sell when everyone is greedy. It's cool. It sounds smart, especially when you say, I'm waiting for the right momentum. The problem? Timing the market is like chasing a rainbow. In theory, it looks easy, but in reality, it's almost impossible. Even professional investors, whose job is to look at charts all day, have access to super complete data and are paid handsomely. They often get their timing wrong. So if you, I, or anyone who is still at the retail level hopes to always get in and out at the most ideal time, well, welcome to the world of disappointment. We often say, I'll just get in when the price drops a little more. But when it really goes down, you get scared. Then we say, let's wait for it to go down further. Instead, the market goes up, and we can only watch while stroking our chests. The historical data is also very clear. Investors who stay in the market, even if it's not the right time to enter, usually have better results than those who go in and out frequently. Take a look at this example. If you invest in a stock index like the S&P 500 and miss only the 10 best days in 20 years, your returns can be much smaller than someone who never leaves the market. And those 10 days often come in the midst of chaotic times, not when everything is safe. So what this means is that our obsession with finding the perfect entry and exit points means we miss the most important moments. Why is that? Because we're not robots. We're human. We're scared. We're greedy. We get nervous when we see the market red or green. And we like to think, I can be smarter than the market, even though we often fall into the illusion of control. That's why many investors end up failing to start. They wait too long for the ideal moment, but it never comes. And when they're finally convinced to enter, the market has already gone a long way. So what do? It's not that you shouldn't think about timing at all, but don't make it the main requirement. Focus on a strategy that can be executed consistently. Whether it's dollar cost averaging, whether it's buying on long-term support, the important thing is, it makes sense, it works, and it's emotion-proof. Because in the investment world, it's not the smartest who wins, but the most patient and the most consistent. Chapter 2, Fear of Excess, when the market bleeds again. Okay, imagine this. The market is red. Bad news is coming from all directions. The economy is slowing down. Interest rates rise. Crypto plummets. Stocks fall. Financial influencers suddenly disappear from timelines. And in the middle of it all, you're told to buy the dip. You think, what the hell is buy the dip? It's a free fall. This reaction is natural. We're human. Our brains are designed to avoid danger, not take risks when things are chaotic, especially if the money used is the result of years of hard work. So when you see a red-hot portfolio, logic goes out the window. What activates? Survival instinct. This is the moment when many investors run away from the field. Yet it is precisely at these points of extreme fear that the best opportunities often arise. Just look at history. In 2008, during the global financial crisis, many people sold all their assets out of panic. But those who dared to hold on, or even buy in that moment of fear, ended up enjoying one of the biggest bull runs in market history. It was the same in March 2020 when COVID hit. The market plummeted badly, panic everywhere. But 3 months later, the market reversed course, and those who dared to buy at that point got extraordinary results. The problem is, we often wait for clarity before we dare to enter. But unfortunately, that clarity only comes after the price has already risen. So we miss the train. Again. And ironically, when the market started to recover, FOMO started to come. We start buying when the price is already high. The emotions are reversed. Fear when it's cheap, excitement when it's expensive. This is where it's important to have a system, not emotions. Because if your investment decisions are based on comfort, you'll most likely buy when everyone else is euphoric and run when everyone else is panicking, which is the opposite of healthy investment logic. So how can you make rational decisions when the market is bleeding? One of them, mentally train for the worst-case scenario. That doesn't mean being pessimistic, but being prepared. Have a plan. For example, determine the risk limit and entry level before the market falls. So when the moment comes, you just have to execute, not rethink. And most importantly, don't wait to feel comfortable to enter, because the best moments often come when you're most uncomfortable. Okay, that's Chapter 2. How scary is that? But that's where the opportunity is. Chapter 3, Misunderstanding Rebalancing, Panic Selling. Rebalancing is like a magic word in the investment world. It sounds cool. It sounds professional. The gist of it? Readjusting the portfolio composition according to the initial target. Let's say you have a plan, 60% stocks, 30% bonds, 10% crypto. Then, as stocks and crypto suddenly took off, the portions became too large. Well, rebalancing means you sell some of what's going up and allocate it to what's going down so that the proportions return to the plan. Good, right? But the thing is, many people don't really understand this concept. The opposite happens. As soon as they see a red portfolio, all red, like spilled syrup, they immediately panic. They say they want to rebalance. But in practice, panic selling in congregation. Not because of strategy, but out of fear. Instead of adjusting portions with discipline, what happened was that they threw away all the assets that went down, then sat sweetly holding cash. They thought, wait for the market to calm down first. But in reality, when the market calmed down, prices went up, and we were once again just spectators. Healthy rebalancing requires planning and discipline, not knee-jerk reactions. Here's a concrete example. Let's say you regularly invest in crypto and stocks. Suddenly, crypto plummets 40% in a month. If you were really rebalancing, you would buy crypto again, because the proportion has dropped drastically. But most people do the opposite. They sell crypto because they're afraid it will drop further. In fact, without realizing it, they sell when it's cheap and buy when it's expensive. Classic. And this all happens because there is no system, just relying on feelings. Even though our feelings are easily influenced by news, noise, and bright red charts. So, before rebalancing backfires, make sure first, you have a clear asset allocation, not random. There is a logical tolerance limit, e.g. rebalancing if the proportion changes by more than 5 to 10%. And most importantly, execute based on data, not drama. Otherwise, your rebalancing will just be an elegant excuse to cut losses and panic. So remember, rebalancing is a tool, not an outlet. Okay, we've covered the 3 big traps: timing the market, fear of market drops, and misunderstanding rebalancing. Now there's just one more big psychological trap before we close: when confidence starts to waver. Chapter 4, Shaky confidence equals quit when it's cheap. Let's be honest for a moment. When we buy an asset, whether it's stocks, crypto, or whatever, we're excited. We have faith. We have reason. Blockchain will change the world. AI will disrupt all sectors. The economy will grow steadily. Anyway, at that time everything made sense. We entered the market not because of FOMO, but because we had an investment thesis. But time passed. The price didn't go up. Instead, they went down. Sometimes it stagnates for months. Sometimes it bumps mercilessly. And at that point, we start asking questions. Am I wrong? Maybe I've entered too late? Or maybe the trend has changed. This is the next trap. Doubt slowly eats away at your initial conviction. If you don't have a strong foundation, it's easy to be tempted to drop out. And strangely enough, that decision is often made just before your thesis is finally proven. It's like planting a mango tree, patiently waiting for 2 years, then pulling it out just 3 months before harvest. Because you're tired of waiting for the fruit to come out. In fact, in the investment world, patience is not just a motivational word, it's a weapon. Great investors like Warren Buffett, Cathie Wood, or Ray Dalio, they've all had periods of stagnation, losses, and even public ridicule. But they kept going because they believed in their long-term thesis. The key? 1. Know why you're buying. Not because of influencers or hype, but because you understand its value and potential. 2. Write an investment log. Write down your reasons for buying, target time, market assumptions, and risk limits. So when doubts come, you can go back and read and remember. Oh yeah, this is not an instant investment. 3. Distinguish between price corrections versus fundamental changes. If the project is still solid, the team is still working, the vision is still alive, then the correction is just a temporary distraction. Sometimes, it's not a new strategy that's needed, it's patience that not many people have. Conclusion: markets don't need fortune tellers. It needs consistent ones. Okay, let's summarize everything we've discussed earlier. We've seen how our obsession with perfect timing can cause us to lose momentum. We also discussed the extreme fears that often make investors flee when great opportunities come along. We exposed the mistake of rebalancing, which is more like panic selling. And finally, we take a look at the beliefs that are easily shaken, especially when time tests our patience. So what's the common thread? The answer is simple but profound. Investors don't lose to the market, they lose to themselves. The market always goes up and down. That's normal. But it's our attitude towards those ups and downs that determines the final outcome. And herein lies the difference between those who always wait for the perfect time versus those who are consistently in the market. Those who fear cheap times versus those who buy when people panic. Those who react emotionally versus those who stick to a plan. Those who switch strategies every month versus those who trust and wait patiently. Markets don't need fortune tellers, because no one can consistently predict the future. What the market needs are long-term players, people who stay disciplined despite the noise, high volatility, and media panic. If you can stick to a sensible strategy with sound risk management and not be easily swayed, you're already ahead of the majority of other investors. Because at the end of the day, it's not the smartest that wins. It's the most consistent and resilient. The investor's mentality, not just the portfolio. Investing is not just about numbers, not just up and down charts, technical analysis, or FUD from social media. Real investing is about mentality, because you can have a great portfolio, assets spread out, diversification in place, neat allocation. But if the investor's mentality is fragile, easily swayed, all of that is meaningless. A lot of times, people get stuck on the sidelines not because they don't have the capital, but because they don't have the courage to trust the process. They know the theory. They know when the market is oversold. They know that red times are buying opportunities. But when reality sets in, panic, hesitated, retreat slowly. In fact, it is precisely in difficult points that the capacity of an investor is tested. So, if today you're feeling left behind, or feeling misstepped, or even feeling stupid because you've waited too long, relax. You're not alone. All great investors have been there. What makes them different is only one thing: they keep going. So, next time you see the market in turmoil, take a breath. Look at the plan, not feelings. Because in the investment world, the one who survives wins. Not the fastest, but the one who doesn't run away from the process. And remember, the market always has a stage, but the stage is not for the audience. It's for the players who dare to take the field, even though they know they'll get dirty, fall down, and maybe lose a few times. But they keep playing, and in the end, they win. Okay, before we end, don't forget our golden rules. 5 important rules of Mr. So Crypto. First, don't use hot money. Use extra or idle money. Do not use money for daily needs or money that will be used in the near future. Second, don't over-leverage. Risk what you can afford to lose if you trade derivatives, futures. Always use a stop loss because the crypto market is very volatile. Third, 70 Bitcoin, 30 altcoin. Always allocate more in Bitcoin because Bitcoin is the parent of crypto. By allocating more in Bitcoin, your portfolio will be safer when the market does not meet expectations. Fourth, always stay cash. Always stay in cash 10 to 20 to buy when the market discounts or drops significantly. Then you can sell when the price has risen. so that you still have cash for the next discount. Fifth, think long-term. Investing is not about 1 or 2 days to get rich. So think long-term and minimize the risks that might make your money disappear. Everything takes time. Remember, Warren Buffett didn't build his fortune overnight. If you find this video useful, help us to continue to make videos like this by clicking subscribe and share with your family and friends. Don't forget to let us know in the comments column if there is anything you have questions about, because your comments mean a lot to build this channel. See you soon, and don't forget, HODL knowledge and mindset first, then HODL assets.